Welcome to an episode of the Global Investors Podcast. I'm your host, Charles Skrillo. Today we have Matt Drouin. Over the last 18 years, Matt has been involved in real estate management, brokerage, and development while growing his portfolio to 176 residential and commercial property units. Matt specializes in repurposing troubled properties to their highest and best use. Thanks so much for being on the show today, Matt.
Hey, thanks for having me on. I appreciate it.
So I was recently on Matt's podcast, and we'll get a plug out for that later on here in the show. But it was, I thought, it's a great person to have on for our show. And so Matt, tell us about your personal and professional background prior to getting the bug and getting involved with real estate investing.
Yeah, to understand where I am on my real estate journey has to begin before the real estate journey, right? So it was definitely came from a place of lacking and not really sure what to find that was going to be the missing piece. Both my parents were, blue collar. My mother was a dialysis nurse. My father was a general laborer at Genesee Brewery. Doing low skill type of stuff like cleaning fermentation tanks and that sort of thing. And, fast forward, it was just growing up in a higher income affluent neighborhood when we were living on the other tracks. I was exposed to, the difference in terms of wealth inequality and that type of thing, and making me feel not so great as a kid, and I was a spoiled brat, right? So I got a hand-me-down Chevy Blazer from my aunt and uncle, and I had, kids that were driving in on their 16th birthday and a brand new Lexus, right? And I was like, I got a free car for crying out loud. So, but it was just from that standpoint of and then, money always created a problem that ended up splitting my parents apart. My father wanted more, was sick of living paycheck to paycheck. My mother wanted my father home. My dad got his real estate license, was selling houses on nights and weekends. And that really led to them being driven apart, and then set on course, pretty much all the traumatic experiences that I had through childhood. And fast forward to in my 20s, I lost both my parents in my 20s due to health reasons. And going through all the estate issues, I realized that they were both living paycheck to paycheck this entire time, right? You as a kid are always your parents are up here on this pedestal, right? They are the model citizens, regardless of whether it's true or not, right? And that whole experience was the universe telling me, you have to get out of the matrix. That's what I referenced, the matrix. And so I found that real estate really was my way for doing that. I was a C plus B minus student in high school and college, and I wasn't going to be the guy that's going to develop the next new killer app. I just wasn't that smart. And somebody told me that the real estate business is the idiot's business, and I liked the sound of that. So I had graduated college. It was in 2006. Couldn't find a job. I was working part-time. This is the best job I could find. Part-time as a bank teller at Chase Bank in the village of Pittsford, which is a suburb of Rochester. And I was just this absolutely sucks. And I was complaining enough to my dad that he was like, hey, if you get your real estate license, you can, I'll show you the ropes. I'm not going to give you any business. I have to earn as much as I possibly can. But that's really what set course for that, because I would have rather eaten a poop sandwich rather than go back into Chase Bank. So I took any opportunity I could, had a part-time job working at a liquor store to make ends meet. And then finally, I saved up about $16,000 in commission checks. And my dad, gave me the next blow, which was, hey kid, you can't live here anymore. You got until the end of the year to move out. So I liked the idea of not paying rent. A lot of adult children probably don't like the idea of paying rent. So I thought of my opportunity to buy something, build my credibility as a real estate agent at the time, because I looked young, because I was 22. And so I bought a 4-family property, and that's when I got bit by the bug. I had $1,850 in rent checks sitting in my mailbox, as if magic happened after I closed on that property. And I was like, all right, this has got to be the way, because I knew how hard I had to work grinding, selling grinder city properties for $40,000. So that was my way. And then I just knew that, all right, this is my way to be able to replace my income. So I just started scaling from there. So for the next 11 years, 25 properties, 76 doors was what required for me to replace my income. And then I started graduating into commercial deals and scaling from there.
So you kind of mentioned it as you were getting involved in being an agent, but was there anything, I guess you didn't see it from your family's standpoint, but was there anything else that really pushed you into the realm of you becoming a real estate investor, not just a salesperson, which is, what an agent is. I mean, so did you see successful people you were working with that were making more money? What was the thing that said, this is the side of the table I want to be on?
Well, I saw my dad investing in real estate and lost his butt. All right. So I learned a lot that way. And that's what I associated like being a landlord was you buy a property, your tenants stop paying you rent, you have to evict them, they destroy the place, and that's just like rinse and repeat of like just a money pit. So I had that as an example of, my dad did it. It wasn't particularly good at it, but I didn't really have anybody besides like, the Robert Kiyosaki's of the world to lean on from this, like the ideation around passive-ish income and building your wealth that way. So that's really what kind of like put me down the rabbit hole with like starting and then scaling from there.
Was your dad done after that first encounter?
No, so he accumulated about 20 properties, about 40 doors over like a 5 to 10 year period. And then the neighborhoods started to change after he had bought in those neighborhoods. And so what ended up happening is he held in these properties, kept them well maintained for like 20 years, and sold them for exactly the same amount that he paid for them originally, right? So definitely not a great hedge against inflation, right? So that was kind of, so he didn't like lose it all, but it was just like it was not the ideal model for in which to build a real estate portfolio, for sure.
I imagine he cash flow during that time though.
Oh, cash flow like crazy in the beginning,
Yeah.
and then the tenant demographics changed in the neighborhoods that he bought in. There was a point in time where they were going on cruises. He was buying my dad was like product of the 70s, right? Was like wearing like fancy jewelry and that sort of thing, and then all of that stopped.
Well, yeah, it's one thing I've found is I don't know what the market was like, but I found that you get markets that are very appreciation heavy, you get some that are a mix, and you get some that are really cash flow heavy. And where I started investing in Central Connecticut, the town I was in the population never really changed. It probably loses I think I figured it out one time when I sold my property, it's like 100 people a year or something. So it was very minor change, but very cash flow heavy, very appreciation light. You know what I mean?
Mm-hmm.
And then you come down to where I am now in Florida and parts of Florida, and it's appreciation a little bit more on that end, but you're still getting that mix of cash flow, but it's nowhere near as high as the numbers, different markets. So it's really market dependent, where I think in slower markets, you're going to have more of a cash flow play, I feel. So it's not all bad. I mean, it's just kind of one of those things that, and also as that neighborhood changes, I mean, it's like you have to adjust your investment strategy to kind of coincide with what's happening there,
Oh, 100%. I mean, I think I truly believe that you should buy the most expensive real estate you can possibly buy in whatever market you have knowledge with, or with a sponsor that has deep, rich understanding of that marketplace, because you're not going to get rich with the cash flow game. You're going to get rich on the actual appreciation game by paying down debt on a desirable asset that maintains or appreciates in value, even if it's meager appreciation of, let's say, 3% per year, but it's predictable. That's really the model that I ended up diving into, buying in the most desirable markets in our neighborhood, Rochester, New York.
Yeah, that's really, people don't really want to talk about it, but that's kind of the one thing is when we're reaching out to, if we're reaching out to people that own properties and trying to, buy them from them, maybe they've owned it for 10 or 15 years. There's one like theme you have with a lot of these mom and pop investors, is that there's no mortgage, whether they started with it, maybe they had 20 years on it and they paid off early or whatever it is. And that's really the key to building wealth in it. It's very difficult, like you said, to, make $150 a unit on an ongoing basis every month for the rest of your life. There's going to be expenses that come up with it. The real game is really kind of paying down that debt, and as you pay it down, your property it just becomes all safer, right?
Mm-hmm.
It becomes safer. Like now, if you have a balloon payment, it becomes a lot easier to refinance. You know what I mean? It's a lot easier to refinance a property when it's a 50% loan to value than a 75% loan to value. You know what I mean? No matter what the market is, especially if it's a bank that you've had years of a relationship with. So that's just one thing. So yeah, I totally agree with what you're saying there. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So let's talk about, Matt, what you're doing now. So you had give us an overview, because Oak Grove, your company, I mean, you guys are doing all different types of things within real estate. Can you give us an overview of really what services your company provides, and kind of an overview of what your current real estate investment strategy is?
Our focus since we started Oak Grove was acquiring historic adaptive reuse properties at a significant discount to the replacement cost. So we've our core focus has been in Rochester, New York. We haven't gone outside of Rochester, and our competitive advantage to focusing on very, very intently on our own market is that we know every player, we know every street, every block, and the niche that we got involved with is this. I noticed that when I bought properties that I appreciated that had historic value to them and unique architectural features and history, even like with millennials and younger people are like craving authenticity, and there's nothing more authentic than than going to these pieces of property that are like a piece of art, for instance. And so I really dovetailed that passion with acquiring properties that people didn't want anymore. So over the past few years, we've been acquiring properties that are, and I know this is going to sound crazy, we've loved office properties post-COVID. There's steep discounts in office buildings. And the way that we do the test of value on there is if this thing was vacant, for instance, could we rent it as like cold storage for like $2 a foot and still make our monthly expenses? And if the answer is yes, then that's something we'll buy, because we have and assuming that it's got to be in a decent location. The reason why we loved office is because the investment community has really like thrown the baby out with the bathwater and redlined that asset class out. So we're definitely contrarian investors in that sense. And this is something where we can cut really, really aggressive lease deals and and basically beat out everybody else that's locked in at a higher basis on those properties, so that we can quickly lease properties up. And then our plan B, if we can't lease them up that produces cash flows that will pay for long-term capital improvements, then we can always pivot. And we're doing this with a couple of our assets right now that we're going to be redeveloping into residential. And so we have a low enough basis on these deals where we can actually have some meat on the bone to be able to do that from an equity standpoint. And also the market is supportive of market rate residential.
Yeah, a lot of great information there. Before we get into the transitions into residential, because I think that's something that people hear and they think that's a good idea. Can we talk about, as I understand, most of your properties that have office are mixed use properties. Is that correct?
Yeah, the property I'm in right now, the Wilder building downtown, which is our next project we're going to be doing redevelopment on, is it's office on top and retail on the first floor.
Okay. So just so that's what people know as mixed uses. My first commercial property was mixed use. And one thing I found when looking at these properties and underwriting them, and I'm by no means at that time or now a professional underwriter, was it was very difficult. I mean, it's very difficult, especially when I'm buying these with a lot of vacancies in them. And usually you would have a commercial vacancy in them. So for me, coming from more of a residential background at that point of a few years and getting into this, what I did to limit my downside was saying that 90% of like the rentable square footage in this property had to be residential. And then that way, I don't know what I'm doing with this commercial. I mean, I might rent it for 1,000, I might rent it for 250. I really didn't know. So that was my way of kind of hedging my downside without really knowing what I was doing. And just tell us about like how you would do it now when you're valuing a mixed use property. And why this is difficult is because the apartments might be easier because you might say 1,000 square feet 2-1, this is what it goes for across the street. There's going to be a lot of those comps everywhere that people can easily find. But when I'm getting into specialty, older properties have units that are a little specialty more, which is like, you don't have a building of just all the same units. You know what I mean? You have one, this is a little smaller. This is an attic apartment. This is like, was a closet that's now an apartment legally somehow. And then when you have it in the commercial sense, you have different, it's where the location is. So, I mean, of where it is on the building, where the parking situation is, I mean, how it's already built out. The other thing too is that you have a lot of people down at town hall that are telling you in the building department what can go there, what can't. So that limits your tenant. So that's this is a huge question, but I'm just saying, like, how do you value, what I'm saying is, how do you value this mixed use property? Because I imagine you're going into to build its value, you're going to have some level of vacancy in there. And how would one value that correctly, and how do you do it?
It's actually super easy. So we buy based upon in-place leases and in-place income. So if we buy a property that's at 50% occupancy, we give no credit whatsoever to the 50% that's vacant. So that's how we are able to buy a margin of safety. So we have 50% of the building that can sit vacant for years on end, and we can still actually cash flow and make our debt service and pay our investment partners. Then that's a deal that we'll do. What's very common in multifamily, for instance, is that you're giving credit for a certain amount of vacancy, like even on a distressed deal, right? So with this, and the reason why we like it is that every lease deal that we sign is pretty much 100% profit. So it quickly drives up net operating income on those opportunities that we do buy. So that's how we do, like, your sort of distressed, poor occupancy commercial assets. And at least that's how we do it. With 100% vacant buildings, the test of value that we do on that is like, okay, what is cold storage rent for out here? Like bargain basement, like, the cheapest of the cheap type of rent. And that's how we base our offer prices on. So like next door to this building, we bought a building probably about 3 to 4 years ago. It was 100% vacant, and it was a 22,000 square foot, 6-story building. We bought it for $175,000. How we determined that offer price was based upon that calculus. All right. They were asking like $350,000 for it. And I was walking through it with my partner, David. And I was like, is this thing worth $350,000? And he's like, I'd have to think about it. I was like, is it worth $300,000? And it's like, I still have to think about it. And I was like, $250,000, same answer. $200,000. I was like, what about $150,000? He's like, that's a no-brainer, right? So you have to acquire these assets at like a no-brainer, like bargain basement type of price. So then you can actually go through the business plan and do that. And we were able to lease up that building within, I think it was like 9 to 10 months. We were able to push the value of that building from $175,000 to $600,000. That was one of our smaller deals, but it was a strategic value to the property we had under contract, the Wilder buildings, which sat right next door to it, because we needed to have a second means of egress if we were going to do a redevelopment, to have a second stair tower, and also have a cooling tower placed on top of the shorter building, so we didn't have to get as big of a crane to bring a chiller in.
Wow. That was making me another question, is that when buying older properties, especially ones that are vacant like that, I mean, there is a ton of regulation that goes into it. I mean, just dealing with the fire marshal, what goes through it. So with you buying it that lower price, it allows you, whether there's fire alarm that has to go in, or whether a sprinkler system, whatever it is, like you said, which is all the thing when we're buying older properties, 100 years old properties, the two means of, ingress, egress kind of thing. And it was just it's something difficult, and making sure that stuff is grandfathered in, because not every unit has it. And it becomes difficult to buy properties, and you really have to buy them with so much of a level, like you said, safety margin, you know what I mean? That if the fire marshal comes in here in a year from now and says, you need to put a staircase down here, or you need to do this, or you need to do that, you have money available because you bought it at such a discount. And it's important to let whoever you're buying it from know, but they probably already know. I mean, it's out there already. They have an idea of what this pushback is going to be from, I imagine their brokers told them.
Yeah, and the thing with, at least as it pertains to code in Rochester, for instance, is that if you are keeping the same use on a property, then that will be grandfathered in. It's when you start changing uses from like, let's say office to residential, then that is what's going to trigger. If you change an office to like, let's say an event, like an event space or a place for assembly class, right? So that is like where you, and this is the really, really great advantage to, focusing on like a few key markets. So, okay, I know the building department, I know the zoning department, I know what makes them tick. I know the actual zoning codes and building codes for this area, so that you can manage your risks and expectations through the process.
Yeah, that makes perfect sense. And as a segue going into how you guys are transitioning from some units maybe to commercial to residential, my first office I had in Connecticut, literally this was a old factory, and this factory was so big they had 22 acres of factory floor. I mean, that's how large this thing was. And when I look at that and I go, it sounds great from the outside when I'm driving by, I can make this into an apartment building, but then I walk it and I'm like there's gonna be apartments here with like no windows. Like how do you go about like designing that and like the feasibility? Because a lot of when I speak to contractors, that a big thing was that years back was that motels into apartments, right? And every time I talk to especially electrical contractors, they'd say it's the electrical. Electrical is so expensive to redo these properties. And I always ask people that when they're doing it. And so what would be for you? I mean, what are some big hurdles that you guys are overcoming in the design and implementation of that business plan?
So the great thing about buying buildings that like were built in the late 1800s is that they depended a lot on natural light. So a lot of these buildings now, so this is a plus and a minus, like a double-edged sword, right? So a lot of these buildings were built with a lot of windows. This building I'm in right now, it's in a U shape. It's got windows on basically on all sides, right? Because they depended upon a lot on natural light, right? Because they had natural gas to actually provide light in buildings, not electric. And so that's one thing. The one additional thing that makes it difficult is when you're redeveloping the building and you're utilizing historic tax credits like we do for these projects, then usually your historic preservation consultant is going to require you to keep any windows and rehab them that are in the building that are still like functional, for instance, or even semi-functional. So that, the window project, if we could replace them all with like, black vinyl replacement windows, which you wouldn't know the difference standing at the curb, like that would be a savings of probably several millions of dollars, especially on a project this size.
When you're working with commercial tenants and commercial properties, another issue I've had from my past, which you can see why I'm not like a huge commercial real estate investor, but for a commercial unit type investor. But the thing that was that finding and underwriting good tenants. Now, obviously, if I was renting out a space for a large national chain or tenant, that's a whole different thing. I can ask for anything, and they'll provide it to me, and it'll be great. But we're talking about going to older properties. Not class A office space. I mean, how do you effectively underwrite tenants in these spaces where people are just starting their businesses? Maybe they don't have the finances. They don't want to sign a long lease. Go through a little bit about that. It's pretty straightforward, we know, with apartments, but how would you do it with commercial?
Yeah, with commercial, I mean, we're definitely taking a look at their personal assets and do they have a significant amount of liquidity to weather the storm? A lot of people that are starting up a business or expanding a business look at their projections with rose-colored glasses. All right. And I know, as well as my partner knows, like it's gonna be a tough run for the first couple of years. So you're gonna be, sinking money into this thing over that time period. So that's number one thing that we look at. We've taken chances on people before that maybe were light on liquidity, but we've required a personal guarantor, like a co-signer that does have those assets. So we at least know. Now, when it comes to enforcing a personal guarantee, are we going to go through the entire process of doing that and getting a judgment that we might get paid on? Probably not. But we know that they have a support system behind them, right? Somebody else that actually believes in their idea. And then credit score. Absolutely. I mean, we run credit score like the exact same way we do for residential. And so, looking at something and it goes on a property by property basis based upon the type of tenant mix we have with a specific deal that we're working on. But generally speaking, we're going to require a credit score range that's higher than would be for residential. We're looking for people that have a good idea that's actually going to have harmony with the existing tenants in the building and with the tenants we want to curate for that building as well. A lot of people are just like, damn, this thing has been vacant for 6 months. Like, I'll take anybody at this point in time. And then you end up putting in somebody that's got, like, let's say a recording studio, and it's next to an accounting firm, for instance. Right? That's not going to be a great mix between those two uses. So it's a little bit more complicated and not so black and white when you're doing residential, but commercial is also a lot less regulated than residential. So if you like, and this is going to sound really horrible, but if you're like, you're going to do essentially like gut checks with potential tenants you're going to sign leases with. And I use instinct a lot when I am evaluating potential commercial tenants. Absolutely.
No, I mean, I think people are using instinct anyway when they're speaking to the first time with that potential residential tenant. You know what I mean? If they're rude on the phone, or they're not answering the question, or they're, and whatever it is, you can kind of gauge somewhat to some level. I mean, just by speaking to someone for a few minutes. So it's, I think a lot of it is that. But kind of moving forward here too, you mentioned this earlier on about your goal of being financially free, building up over so many years to going to 70 plus units, and you're able to reach that goal when you're 33. One thing I find when people are going from, like, you start with $16,000 to building a $15 million portfolio, and real estate's a very capital intensive business. So, I mean, how did you grow those assets? Was it really a lot of financing that you worked, a lot of terms that you worked? I mean, what was some of the basis for you being able to do it, other than you being a very hard driven worker?
So the first chapter, right, in my small multifamily residential career was a lot of seller finance deals, a lot of deals where I was purchasing properties with hard money, where I was able to increase or force the appreciation over a short period of time and then place bank financing on that and not have my own capital as a bottleneck to that. And I was having hard money lenders that, they'd write checks for, like, let's say 300, maybe 350 tops. Right. When I started getting into, $1 million plus deals, I went back to those same hard money lenders and I don't have cash that big. And certainly if I did, I wouldn't be, overexposed with you. So that was the first time, like, when I first bought my first, $1 million plus commercial deal, was an office building, and it was $1 million deal. And I had to come up with $300,000 in cash that I didn't have. So I went back to those hard money lenders. I was like, hey, I need $300,000. You lent it to me before. Can you lend it to me again? And this is my business plan. And, I paid you back, and, with interest and on time and ahead of schedule and all that stuff. And they're like, is it in first position? I was like, no, the bank's gonna be in first position. All right. And and there was like a hard pass, like, on every single of these lenders that I worked with, even though I had the relationship. It's just sort of so much outside of their brain chemistry. There's just like, it's like an antithesis to what they know. Right. So then I started having to go to non-real estate sophisticated people for private money, right? And if you pitch an opportunity where somebody can earn an 8% fixed rate of return, partially guaranteed by you, paid back with their principal in less than 5 years, you present it to somebody and they're like, damn, where do I sign up, right? You present that to an experienced, like, real estate investor, is like, well, I can get 15% doing it on my own or just lending it out to somebody else. So it was a difficult transition to going from hard money lenders to what I'd call private money lenders.
When you were doing those deals, because this is something that people might be interested in doing, and I'm interested in learning how you did it, but you're going to the bank, you're getting your 70%, let's say, loan to value, then you're going to private lenders, you're going to get your 30%. You're getting multiple people to put this 300 in. How are you structuring that? They're going to have an actual mortgage on it, second position, and everybody's wrapped into one. So it's like an LLC that owns that mortgage, and it's all your investors. How does that work?
Promissory notes to our LLC. Yeah, it's as straightforward as that. And it's collateralized by our membership interest in the actual property itself. So it's not a mortgage or anything like that.
I'm sorry, because the thing is that you'd have an issue with your bank. So you just explained that, correct? Yeah.
Yeah. So, and then your bank may have an issue with that, either, like, in some cases, right? So it's like, okay, well, are you still able to make these people's payments and also make debt service coverage ratio of 1.2 to 1.25? So there's that. And most banks, if you have a great relationship with them, a great track record and a great reputation around the community, because bankers do talk to each other, generally speaking, they're more flexible in working with you on creative financing and that sort of thing.
Yeah, it's all the relationships. I found that so much in getting into small commercial deals, anything like that. When you're dealing with it's local banks, it makes all the difference, and they provide deal terms to you and specifics that are really just unmatched between banks and local credit unions. So, great information there. The other thing I found when looking into doing financing, like you were just saying, is that the banks also don't want to butt heads if you have to foreclose with another lender, right? And it's interesting because this model is done all the time in residential personal primary homes, right? One bank somewhere has the first mortgage on it, and then some local bank, you know what I mean, is picking up like 10% or something like that, or giving you in like an HELOC or something. But when you're getting into commercial, it's a whole different story with that. So I think that's one thing that investors aren't really, maybe new investors aren't really sure about how they can structure it. But promissory notes, I know another investor here locally where I am here in Florida, he does the same thing when he flips houses. So he does like luxury flips, and he will get he's buying a $3 million property. He'll get $2.5 million from from a hard money lender. And then he'll get the rest, like all in just increments from in promissory notes for people that he knows really well. So it works well, and it doesn't scare off, you know what I mean? It doesn't scare off that hard money lender saying that, hold on, there's gonna be someone else here. It's like, it's just you in line, you know what I mean? And then they're just got your membership shares. So they get like, first right to that.
Yeah, I mean, and that's a great thing about deals you can do, like marrying hard money or seller financing with private money via promissory notes, is that you don't have a bank you need to like open your kimono up to. All right, so like we bought deals through conventional bank financing, and then we bought deals direct to seller with seller financing, and also through brokers too. There's definitely a lot of people put shade on brokers for like, well, they're not, they're going to shoot down seller financing before they even like present it to their client. But I always do 2 offers when I make an offer on a deal, or even 3 offers, right? I make a cash offer with bank financing, and I'll make another offer or 2 with some type of creative or seller financing deal. And also in articulating in that there's also capital gains deferral benefits from doing an installment sale via seller financing too. So.
Yeah, no, a lot of great information there. I found that when you're dealing with sellers, it's easier to bring up seller financing when you are going straight face to face with them. And then I've also found, there's finding out what the seller really wants, whether it's that top price, whether if they're taking terms, if it's going to be the interest rate or the down payment. And if you find out what they really want and what they're really focused on getting, and then you kind of build the rest. And usually it's not the down payment. It's usually like getting that price and whatever they have to do. That's how I found it over the years.
Oh yeah, I think there's psychological like anchors in all of these sort of moving parts with the transaction, and I mean I was victim of it myself. Like I had a deal that was off market. It was 17 units that I sold earlier this year. $1.8 million was my price, and I wasn't going to go a penny below that. Right, so I got an offer from somebody for 1.7 million. And I was like, I won't take it, but I'll get creative to get to 1.8. Right, so they said, okay, well, can you hold a second mortgage for $100,000 with no interest and no payments for 5 years? I said, done. Sure. So we made a deal.
Yeah, and now it's backed by the property that so it's even safer than if you were just a hard money lender with a property and that you didn't even know about. So I find that much easier because it's something they know. They know that property better than anyone in the transaction, and if they've owned it for so many years, they know all the ins and outs of it, and it's most likely going to be a safer investment than any other lender coming in to put that money down. So they're most likely to go a little higher on that. Of what I've found, and it makes sense. If I'm selling a property that I own, I would probably do the same thing.
Absolutely.
So as we're kind of closing up here a little bit, there's one thing I know last time we spoke, and it was kind of off air when you were interviewing me for your podcast. And one of the things you mentioned is that in all these different commercial deals, you had one and you turned down a rent increase of $5,000, and kind of stuck with me. And we didn't get into too much, but can you kind of give us a story of, you had a tenant, you said you weren't going to renew them. They said they're going to give you an extra $5,000 a month. You turned it down still.
Okay. This is another benefit to not having equity partners. So I'm sure that there's not a lot of other people out there. So they can speak to that. But I prefer to have straight up just capital stacks where it's myself and my partner David that are calling the shots of what we feel is best for the community and best for the deal and best for the subject neighborhood that it's in. So there was a 28 unit mixed use deal that I'd acquired probably about 5 years ago. There was a company that I can't name names, but to protect the innocent here, they were in the business of renting out furniture, right? To low income people. And it was a very predatory business model that wasn't in alignment with my values. This property was 2 blocks away from my house, so it was just an element that I just didn't want as part of our neighborhood. So they had a 5-year renewal option that was undefined. So that was like my little, like when I was doing my lease file audit during due diligence, I was like, all right, that's my way to get them out. So they had, they said, okay, well, we're paying $2,000 a month now. We'll offer $4,000 a month. And I was like, how about $12,000 a month? Because there's Starbucks right down the street that pays $28 a foot, and you're proposing to pay $11 a foot. And so then they counter back, and then eventually we got them up to $7,000 a month, which is $5,000 more, and then, I countered them back again, and then they walked. And then, we reprogrammed the retail for that mixed use building. It's just so much more of an asset to that neighborhood than what was there before. It's like, and believe me, it was tempting when they were up to $7,000 a month. I was like, damn, I don't know, maybe I could do that. And then I could give some money to the neighborhood association for, neighborhood improvement projects and that sort of thing. But I ended up just sticking to my guns. I promised myself that I was not going to have them there, and I didn't want to break that promise to myself, nor the other people that I told that I was going to do that too.
Yeah, that's great. I mean, more power to you. There's a lot of real estate investors that would not have made that trade-off. That's why I want to bring it up here, because everybody tells you about how they want to help the community. And, I understand, we're fixing up stuff. It makes it better. I got it. But that is something where you're actually changing right away the trajectory of a neighborhood, because they'd probably be in there if they got renewed. You might sell it. They'll still be in there, still paying their rent increases. And I imagine a corporate tenant or corporate landlord comes in and buys it from you. They're probably not going to have as much of care for that neighborhood as you do.
Yeah, no, absolutely. And that's why, we do equity participations with the larger deals that we do. But I think that we have these 2 different types of deals that we do, right? We do smaller deals where we keep all the equity, so then we can actually call the shots that are in alignment with our values. Listen, if this was a deal we had equity partners on, and now there's a fiduciary responsibility there, we would probably have been forced to do that deal, right? But we didn't, because we didn't have that structure.
For sure. That's a great model. As we're kind of finishing up here, I mean, what are some common mistakes you see real estate investors make over all your years, almost 20 years in the business?
Oh God, just not, I don't know. There's so many ways I could answer this question. So I think that, active investors, focusing on the relationships first before they start going out there and looking at properties. The mantra that I hear all too often is, find the deal and the money will come. I think that it's important to start, quote unquote, raising capital before you need it via relationships, because relationships only move at the speed of trust. And so I think that's the biggest mistake that I see out there. And then that might work in smaller residential, but it does not work in commercial when you're raising investment capital from private money, for sure.
Yeah, no, that's a great one. That's the first thing when I'm coaching people. That's the first kind of conversation we have. Is there any chance you're ever going to raise money in the future for doing this, or is just your own money? And usually they say they are, and I'm like, all right, now you have to start putting together the database. This is a whole thing, you know what I mean, of potential investors. So Matt, how can our listeners learn more about you, your business, and your podcast?
Yeah, we host the podcast on our YouTube channel, and then I put on a lot of long form educational content on the YouTube channel. I'm all over social media. It's my it's my job with our company, unfortunately, is to be on the marketing and sales side of things. So, but YouTube is probably the best way for me to give you as much value as I possibly can. And feel free for anybody that's listening to reach out to me. I'm an open book. There's no secrets here, and I'll stand by it. It's still the idiot's business, even though there's a different order of magnitude.
Well, thank you so much for coming on today, Matt. I'll put all those links into the show notes for your business, your podcast, etc. So I'm looking forward to connecting with you here again and sometime in the future.
Absolutely, Charles. Thank you.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.